I get asked all the time, best financial advice. I say 4 words: live below your means, whether you're 27 or 87. Sounds easy to do, but you can do it.
This is the Dough Roller Money Podcast. I'm your host, Rob Berger. In this episode, I am thrilled to have Jack Brennan with us. Jack has a long history with Vanguard. He was at one point a chairman and the CEO of Vanguard from 1996 until 2009. He's also the author of a book that he recently re-released, More Straight Talk on Investing, which we'll talk about during the interview. Jack, welcome to the show.
It's great to be here, Rob. Thanks for having me.
Well, I am thrilled that you were able to join us. Thank you for your time. I got a lot of questions about investing, but I want to start off with a question that I think it's difficult for me, to be honest with you, because I am a long-term Vanguard fanatic. I'm a boglehead, you name it, right? And I have been pretty much all my, investing, which as I get older, gets longer and longer. I guess that's a good thing. Anyway, enough beating around the bush. Lately, Vanguard has taken some criticism. I'm sure you probably saw the Morningstar article. I'm looking at it now. Has Vanguard lost its way? And the criticism, some of it's customer service, some of it is maybe a heavy focus on the advisory services that they're very inexpensive, but still a little more in fees. And some of it relates to some of the new investment strategies that they're focused on, like private equity. And I guess my question for you is, do you think any of these criticisms have any merit?
Listen, I may sound like an apologist, but I'd say no. You could go back and find that story written many times over the course of the last 40 years. And it's the core of Vanguard is a singular commitment to its client owners' well-being. That means you have to adapt and evolve. And you have to move away from this or that part that is either out of date or maybe not relevant anymore, and evolve towards something different. I literally could give you can't imagine how many questions. When we were the first company to bet big on the internet, we got criticized because people thought we were dehumanizing our customer service. We went into the ETF business because we thought we could bring Vanguard's products to a whole nother segment of the world who wouldn't come to us direct. Well, that's turned out to be a great thing for the market. You see the effect in the market. So listen, people can be nostalgic and say, I liked it when, but you didn't like Vanguard in 1982 relative to Vanguard today. Cost, breadth of services, breadth of offering. So listen, are there always going to be challenges in any big organization? Sure. But as it evolves, it always hews back to this singular interest in serving its client owners. And so I actually read the criticisms with bemusement, I have to say, because, it's Tim Buckley now. It was Bill McNabb. It was me. It was Jack. You go right back through the leaders of the company over its lifetime. And there's always been criticisms when change occurs. But if you look on a secular basis, what the company can do and the impact it has would be nothing like what it is today if it was static.
Right.
So that's and again, I'm not an apologist. I'm a critical business strategist, and I like the way things evolve. You just think about the people who are helped by the advice services. It's a tremendous resource for people, far better than a robo only. But if you want a robo, you can have it. But technology plus a human being, it's fantastic. Is there a fee associated with it? Sure, but there should be. And if you combine that fee with the underlying investments, pretty damn good value.
Yeah. Well, I mean, in the world of like human advice, 30 basis points is about as cheap as you'll find it anywhere, I think.
And listen, from an institution you trust, right? Who is going to be here. It's not somebody who's hoping to get bought by JP Morgan. This is an enterprise that's going to be around for many generations for you. And I think it's one of the great innovations, frankly. I talk about it in the book in the last 20 years is the availability, price points, delivery mechanisms of advice. And the Vanguard program is very successful. And I think it's just starting out, to be honest.
Yeah, and who knows, maybe Vanguard will buy JP Morgan. Well, probably not. I mean,
No, you don't get into those conversations. Jamie
no.
got in trouble making forecasts on who'd outlast who.
Okay. All right. Well, you mentioned your book, and I have a number of issues. I get asked these questions all the time, and but I think we can benefit from your experience on this. And the first one is inflation,
Mhm.
and you talk a bit about inflation and bonds in your book, actually at length. So I guess my question, I don't want you to predict inflation, although you're free to if you want to give
No,
that
I'll
a
skip
shot.
that.
Yeah. Right, but obviously it's a big issue right now. The current inflation has gone up significantly. Who knows what the future holds? How do you think long-term buy and hold, sort of saving for retirement investors, how should they position? I'm thinking primarily their bond portfolio, but I don't know, maybe their stock portfolio as well, in light of the risks that inflation it presents for us right now.
I think it depends on your age at one level. So you say long-term buy and hold, if you're talking about a 40-year-old. My own view is, the best inflation hedge is equities. It historically has been equities. Starting with a lower yield than historically as well when inflation has occurred. But inflation hedges, you think about them, on the one hand, I'll take equities to start with and say, one should be as aggressively invested in equities as you want to be, as you can be, because companies don't like inflation, but many companies benefit from inflation over time. There's this perverse math, right? You know it well, Rob, on the bond side of things, where if you're not consuming the income, you want rates to rise.
Right.
Because you make all your money on the reinvested dividends. And so inflation, in a sense, shouldn't be something you fear, but you should be aware of, I think, as a long-term buy and hold investor. I'll say accumulator. It's different if you're in retirement, because inflation affects you in your daily life, not just in your investment portfolio. And I think you have to be very strategic about it. It's a place where I think getting help of some form or other from an advisor is particularly important. I'm a child of inflation. I came into the workforce in 1976, and it was stagflation. And, the fun facts, right? Dow crossed 1,000 in 1968. It crossed it again in 1982.
Right.
That's a long run. And so I think one has to be very aware of how you're spending, from what you're spending and I'm including rising rates in an inflationary environment. Doesn't necessarily have to happen. But again, I come back to equities being your best bet, your best hedge. And then importantly, and again, you know this well, the outgo is just as important as the income, right, from your portfolio. And you need to think about how you're spending as well in an inflationary environment.
Yeah.
Most of us have no experience in it when you think about it now. Unless you're my age, you haven't seen an inflationary environment at all. And I was 21.
Yeah.
And so
I'm old enough to remember a 6-month CD getting me 16% in 1982, but I wasn't retired then or close to it.
exactly.
And it does present challenges.
Well, and cash historically, cash is about broken even with inflation. So you need to think about that. But one of the things that, I think has fallen by the wayside a little bit is things like CDs. CDs at a decent rate are not a bad inflation hedge for you, and maybe better than volatile bonds.
What about a portfolio on the bond side, particularly as you near retirement, and you have to start thinking about income? An approach that puts, let's just say, roughly half of your bond portfolio in nominal bonds, whether it's a BND from Vanguard or a Treasury fund. I'm thinking intermediate term, but and the other half linked to inflation. I guess primarily tips.
Yeah.
Is that so you're kind of hedging your bets. If inflation's higher than expected, the tips win. If it's lower than expected, the nominal bonds win, and you're kind of just spread out. Or is there some other approach?
Rob, I think that's exactly the kind of strategic thinking people should be doing. And we didn't have, the last time we had inflation, we didn't have inflation-linked bonds.
Right.
So it's an arrow in the quiver that wasn't around in the 70s, right? Bonds were known as certificates of confiscation. They just lost money every day when you got up, right, for 7 or 8 years. So tips are an interesting thing. And of course, tips, but you got to know how they're valued going in, right? You don't want to overpay for tips because you'll give up some of it. But that's why thinking about this, particularly when you're a consumer of capital and needing income, is such a critical part of how people should be thinking about. And maybe, with luck, inflation will be transitory, the word that seems to be being kicked around a lot. But I believe everybody should be thinking, what's it like if prices rise 4%, not 2%?
Yeah.
It's a big deal.
I'm curious just to dive into the weeds for a moment, because you said talking about overpaying for tips. And I think of it typically as buying a tips fund versus individual bonds. But when you think about overpaying for tips, is it a question of trying to assess whether the spread and the yield is overdone, or how do you think about the value?
Just the simple metric of break-even inflation rate.
And how do you evaluate that?
It's a number you can get. You can put break-even inflation rate on tips in Google, and then you have to make your own assessment. That's the
what
point.
I'm getting at right
exactly,
there.
Exactly. And so if you're a bear on inflation, you want a high break-even inflation rate.
Yeah.
And that's the question. And again, it's, for most people, it sounds really complicated. And I think doing a little homework on it, because as I said, it's a tool that didn't exist the last time we went through an inflationary environment, and it should be evaluated if you're there. Again, I'm a big believer, and it's a little heretical to traditional thinking, that a heavier component of equity, of high quality equities, is again going to be your best income and inflation hedge. Mm-hmm. If you look at over any secular period of time, dividends from high quality stocks have outperformed inflation in any meaningful period you want to look at. Okay. That's a different strategy than thinking about your bonds. You take your income, or even realize some gains, but I'm hoping I live 30 years from now, right? So I'm a long-term investor at age 67. And thinking about that basket, and not high yielding equities, because sometimes they're high yielding for the wrong reasons, but high quality companies that grow their dividend at inflation plus 3 or 4 or 5, and that's another very important strategy. It's uncomfortable for some people because it feels risky, but if you're not consuming principal to any great degree, it's likely a better way to think about the next 15 years if there is an inflationary environment.
And I guess that kind of leads into my next question, because I hear from a lot of people, they understand that stocks outperform bonds. They understand even in inflationary periods, given enough time, stocks outperform, but they're scared. And they say, look, we say bonds are expensive. My goodness, look at the real yield, earnings yield on stocks. It's negative. And so is the thinking, and we could be in for a downturn, but you just hold on and you just, live through it? Or is that kind of the way you would approach it?
It is for me. And again, it's why I think the draw rate, if you will, gets underappreciated for people who are in retirement. Okay. I get asked all the time, best financial advice. I say 4 words: live below your means. Whether you're 27 or 87. Sounds easy to do, but you can do it if you set yourself up. People who are listening to this hopefully can do that. And so that's the critical element. If you're drawing 6% off your portfolio, you probably can't afford to take the risk of equities. If you're drawing 2%, you can.
Yeah.
And because 2%, you probably cover it mostly with the dividend yield. And it's those things. Again, this is not rocket science, but it's complicated for people. And then my advice to people is, I always say, just close your eyes. I mean, I would no more open a Vanguard statement than I jump out the window. I just don't care, because I have these assets. They're here for a long time. And, paying too much attention to your portfolio is never going to be good for you. But if you can get your spending rate in that 2 to 3% range, I don't believe actually having a far higher commitment to equities is risky.
So are you not a believer in the 4% rule, or it's just more a question of if you can keep it lower than that, it gives you a lot of flexibility?
So the 4 used to be a 5, if you remember, when those of us with gray hair had different color hair, and endowment foundations do 5. I think you can do 4. I think 4 is aggressive personally. Because again, you already mentioned it. What do you think a diversified portfolio is going to do from here? And then what do you think inflation's going to be? And so, listen, I've said for decades, you should shoot for 3. And if you can do better than that, meaning less, the better. And that requires some discipline and some planning, right? Whenever one of my contemporaries said, bought a big new summer house, I go, ooh, okay. I hope you did the math, because you're increasing your cost of living at a time where you have less control over your resources versus when you're working and you're going to get a raise and so on and so forth. So listen, if I were the king, I'd be pitching 3 to everybody.
Okay.
Because I just think it's a safer way to plan your future.
Yeah. And as you point out, it gives you a little more flexibility in the sort of risk that you take in your portfolio, which can help you long term. Another question that comes up a lot for me is I get a lot of people saying I have no use for international stocks because they've so underperformed. I know you discuss this in your book. And of course, Jack Bogle doesn't help in a way because they'll quote him. And I'm curious, though, can you kind of share with us your take? Because one argument would be now's the perfect time. Here, if we're value investors, at least some of us, we should be piling into international stocks. So what's your take on whether a diversified portfolio should have direct exposure, to international companies?
So I'd say there's two answers. One, if you want to have a wholly domestic, and no portfolio is wholly domestic because, whatever, if it's J&J, it's got a huge international business. As an American, you can legitimately have a wholly domestic portfolio. You have no international liabilities. You don't take any currency risk. You get plenty of diversification. So it's fine. It's not at all a wrong answer to say I don't want international equities. In my view, you're giving up both diversification opportunities and growth opportunities by doing so. And so I'm not as aggressive about international as some people are, but I think 20 to 30% of your equities international gives you that diversification and growth opportunities. Again, you have to be patient, right? Yeah. In 1989, if you bought the Japanese index, you're still digging out of that hole, right? It's a long run. But I'm a huge believer that getting exposure across sectors, across individual companies is advantageous. My biggest personal assets, VTI, the total index at Vanguard. And if you can add to that additional diversification, and I think in places like emerging markets where, inherently there should be better growth, you should do it. But if somebody, if you live in the Netherlands, I don't think you can have a wholly domestic portfolio, right? Or Taiwan. But you can do it here. I think you just give something up, including risk reduction in the long run through diversification.
Yeah. All right. Well, let's talk about rebalancing, another topic that you discuss in your book. Yeah. I guess the question is there an argument for not rebalancing? And kind of related to that, how should you think about taxes and rebalancing in a taxable account?
So the answer to the second one is you should absolutely think about it, right? I always think of Warren Buffett, who has accomplished so much. And one of the secrets to Berkshire's success is tax efficiency, right? No dividends. You choose when you want to realize, but they're going to keep the money at work. And so if you think about your Berkshire account, it's far better than if you had not paid attention to taxes. So I think you absolutely have to pay attention to taxes. Listen, depending on time frame, there's absolutely an argument that you don't need to rebalance, particularly if there's taxes involved. I think the question becomes, I'm sure you have. I tell people, think about it once a year. Think about on your birthday or New Year's Day or whatever. And the question, are you always alert to the incremental risks you're taking one way or the other by not rebalancing?
Yeah.
And again, it's just discipline like anything. And so you say, you know what? I'm comfortable. Does that mean my risk tolerance is higher than it was? Well, maybe my risk awareness is better than it was, so I'm okay with it. So if you don't want to rebalance, don't do it. But at 2 points or 3 points or 5 points, at 15 points where we could be today, if you've let it run for an extended period of time, you have a very different set of risks in your hands. And my own view is you should do it. And then optimally, you rebalance. You do the rebalancing in a tax advantaged. You do it in aggregate. You don't rebalance your 401k.
Right.
You rebalance the portfolio as a whole. So you may end up with a lot more something in the non-tax advantaged account and a lot more something in the other one because it's tax efficient.
Sure.
But I do think people should systematically take a look and at some outside some guardrails, either make a conscious decision not to or do it, even with tax consequences, because the regret risk is very high, right?
Yeah.
It's very high.
Sure. Yeah. Kind of switching gears a bit. Let's talk about crypto because, why not? That seems
Why
like
not? We got to. It's Wednesday.
Yes, right. First of all, has Vanguard done anything in crypto?
I don't believe so. I'm not on top of everything, but I believe the answer is no, and I'm glad.
Do you think they ever will?
There are two elements to crypto, right? There's the technology of blockchain and things, and then there's the trading medium. I'd be surprised, but I'll probably be one of those guys saying Vanguard's changed if they come out with a crypto fund. But I have to say I'm always encouraged by some of the smartest people I know in investing who say I don't get crypto. And what frankly, and I'll say Bitcoin, not just crypto, but Bitcoin. I'll pull out a chart of the gold price from 78 to 83, and it looks like the Bitcoin chart. Looks like the Bitcoin chart. And Vanguard's strength is not trading things, and Bitcoin at least is a trading medium. It's not a medium of any inherent value. It's what will somebody else pay you for it. And so you can hear I'm a skeptic about fads like this, and the headline value when it drops by a bunch or headline value when it goes up a bunch, and it feels exactly like gold and silver. The peak of the silver price was $50 an ounce in 80, I think. I don't know what it is today, $10 or something.
Yeah.
And silver actually has some inherent value, right? Yeah. It's in your catalytic converter. It's a lot of gold has some intrinsic value, but gold, if you look at gold as a 30-year, exactly. You look at gold as a 30-year investment, it's been off.
Yeah. Well, I guess that's the argument that some would make with Bitcoin anyway. They said, well, look, it's the digital gold. And so, if you evaluated it as an investment in and of itself, maybe not a good investment. But if you think about it as maybe 2 to 5% of a portfolio, and there are people, bright people that would include it in a portfolio, like a Ray Dalio, for example. I don't know his position on Bitcoin, but certainly some of his portfolios have included gold. But folks will argue that Bitcoin is the equivalent of digital gold. And, for a well-diversified portfolio, it can make sense for some relatively small percentage. What do you think of that approach?
I've never bought the relatively small percentage argument in a long-term portfolio. And that includes gold.
Okay.
It's expensive to hold. It's doesn't yield anything, et cetera, et cetera. And I look and I say, so you put a relatively small percentage in it. What does it do for you?
Right.
some downside protection, some inflation protection. If I'm running an endowment or a foundation, which our retirees listening to this are running their own endowment, do they think that's going to outperform a diversified asset, a diversified package of equities and so on? Hard for me to imagine. And do you care that much about some minimal volatility minimization for you through digital gold or gold? So I've never been a buyer of the argument. If you're a market timer, it's a different issue. But if you're going to market timer, you got to do it more than a relatively small part of the portfolio. Right. So other than that, I think it's a great idea.
Right. Good. A lot of folks, when they talk about the markets being overvalued, they worry about a decline of whatever, 10%, 20, 50%, pick your number. But I think a lot of folks, I'm going to guess that you're in this category, can think of a lot actually more dire circumstances than just a whatever, 30% drop, because we remember periods that, for decades or longer that the markets didn't move. Or, you mentioned Japan over the last 30 plus years. What do you think are the risks that could happen? Are there risks that could happen in the United States? And I guess the broader question is, what do you think are the biggest risks today for sort of the long-term investor in the United States?
So, let's say, can the 30s happen again, in a sense? Because that was a terrible period to be an investor. And, for me, I don't see it. I think we're much more sophisticated. You can criticize the Fed or not. You can do this or that. But, as a country in the U.S., and as a developed world, we've become much more sophisticated with tools to avoid cataclysmic situations like the Depression in the 30s. So that would be a big risk, that the economy just collapses and stays down. Okay. I personally don't see that. I think we stress tested it in 08 and 09. Brutal period of time. Yeah. Everything you said happened. We used innovative techniques, monetary policy techniques, and some more fiscal this time, and rebounded. So I think there's a greater inherent resiliency in the U.S. economy and in the developed world economies today than there were in past periods where you went through something like that. So I, for one, don't worry about a very extended period where, again, stocks could come down a bunch because they are highly valued, but some would say highly valued compared to what? They look less highly valued compared to alternatives, right?
Right.
But the resiliency, the diversification of the economy, to me, almost eliminates that cataclysmic risk. 10-year bear market or a 10-year nothing market absolutely could happen. You've probably had Jeremy Grantham on your podcast at some point from Grantham. I'm GMO, and he's done consistent forecasts for many, many years. They always look wrong until they look right. And he's pretty bearish about the next 10 year. I guess they do 7-year forecasts because compression evaluations may be more attractive alternatives if rates rise some. But again, none of that is none of that's cataclysmic, nor would it prompt me to say, put all your money in CDs, which if you knew it was coming, you would do, right? So your opportunity cost would be zero. So, do I think we're going to do what we've done the last 10 years in the next 10 years? No, from a market, but could be wrong. But I don't see, so if I'm a 35-year-old, I want to be a every 2-week investor in equities. And in some ways, you want that flat 10 years.
Right. Oh, sure. If you're in that position,
you want that flat 10 years. If I'm a 65-year-old, which I am, I'm not worried about it I wouldn't get conservative today because we're at relatively high valuations. nor would I spend a minute worrying about a cataclysmic result that could last for 10 or 20 years. Long-winded answer, sorry, but
No, it's a good answer. I mean,
for you.
And at one level, what can we do about it, really? I think a lot about maybe some sort of major cybersecurity issue, but again, it's not as if I can control that. Other than not clicking on links and emails that get sent.
Which is a good habit. In other parts of my life, I get a good look into the defenses that we have, and the bad guys get smarter and the good guys get smarter. It's always a risk there, of course. And there's always geopolitical, right? There's geopolitical risks, but frankly, I think you'll get older faster if you spend a lot of time worrying about things you can't control.
Yeah. So tell us about your book, why you re-released it, and what folks can learn if they read it.
So COVID is an interesting period of time, right? And I wrote the first version of this book after the dot-com bubble because it just felt like sort of sensible, tried and true needed to be put on paper. And frankly, the post-global financial crisis euphoria in the markets, Bitcoin, day trading, I'm quitting my job. It's a reprise of 1999 in some ways. Mm-hmm. So I decided, and I enlisted my good friend John Worth to help. And, you step back and you say, so I read the book again and said, almost 20 years later, did what we say here hold true and actually serve people really well through a period of a spike, a collapse, a long run, a short collapse? The answer was yes. But there's lots of new stuff as well that's happened. And, I say right at the beginning of the book, Rob, that I think it's the best time ever to be an individual investor. And it's because of things like the cost to invest is through the floor, right? It's, the total cost of ownership of assets for your average retail person's down like 60% in 15 years. Yeah. We like to call that the Vanguard effect, but that may be a little egotistical. If you want to go on autopilot, you can have a target date fund. It's a fantastic product for somebody who's saving for retirement in a 401k plan. ETFs, right? Efficient, liquid, cost efficient, low cost. You go right down the list of things. Talked a little bit about advice already. So anyways, all that came together and said, let's do it again. And the fun part is you update data, you get new data in, and these sort of basic principles of diversification, of low cost, of discipline, of not trading, just hold true. They held true in the 30s when everybody had gone through the 20s and the roaring 60s, and they held true in the 70s. And so that was really the motivation. It was fun to do, frankly, because I was not born with a nostalgia gene. So I don't really think much about yesterday. So it was a good exercise for me to say, was the first Straight Talk worth doing, and is this worth updating? And there's and the reaction from readers has been really fun and good. That I think there's been a little dose of reality. Some of the guys I've talked to on blogs look at me like I'm 712 years old, and that's okay, because the kind of stuff we write about in this book is not glitzy and glamorous. It's just how you work your way to wealth, and it's been proven again and again over decades and probably centuries. Yeah,
well, it's a phenomenal book. I highly recommend it for those listening who have not read it. Excellent. And really, I mean, it's, there are those books out there that just one book and you pretty much know what you need to know to be a sound investor. And there are several that I would put in that category. Yours is absolutely one of them. So excellent book. Well, listen, thanks so much for coming on the show. If folks want to follow you and follow your work, where might they do that? Is the book the best way?
It's more episodic. I'm doing a lot of things, none of which involve being on social media platforms.
Good for you.
I do think, as I said, when I wrote the first book, the publisher said, geez, it should be 50 pages longer. And I said, every single thing I know about investing is in this book. The last 50 pages would be useless. So, you can Google me and I show up places, but I'm not much of a talker. Actually, I'm much more of a doer.
Well, the book is excellent, so I think that's the place for folks to go. Jack, thank you so much for being on the show today.
A real privilege, Rob, and thank you. Most enjoyable. Best of luck to you.